Hello, it is Saturday, September 24th, 2022. And to wrap up today's conversation, I want to talk about risk management, the final bullet point down here. Most people, most newer novice traders tend to focus on how much they can gain, how much they can profit, focused on the upside, and not so much on the risk and the potential downside. So, one of the first steps to increasing one's trading skills and risk management skills in markets is to think of the loss potential first. So, think of the downside. What can I lose? Where am I wrong? And have a disciplined loss taking process. So not something that's willy-nilly, let me see how I feel, let me give it a little more time. I hope it turns around. I can't sell now. I'm down too much. All of these thoughts that everybody's had at one time or another, and some people continue to have, it's not the way to trade. It's not the way to be a profitable market participant. I can tell you that. So think of the loss potential first. It should be an unemotional process based upon some criteria. The criteria is going to be different depending upon what your strategy is, what your time frame is. For me, I'm just going to give you a couple of basic examples. This is not trading advice. I'm not saying I'm going to take these trades or you should take these trades. I'm just using this as an example. So it's just an example. This is the weekly chart of Netflix. So if I'm swing trading, so that means my time frame is at least a few days, maybe a week or two. I'm swing trading. I'm holding it overnight. I'm letting moves play out a bit more than a day trade. I want to be able to risk at least one 14-week average true range. So look at the bottom here, ATR 14. This is an indicator you can pull up on your charts. The 14 period ATR on the weekly chart is 26.7. So basically a little more than 10% of the current price. Basically, if I were going long Netflix here at Friday's close, 226.41, I need to risk at least a move down to 200. So if I'm going long on this chart here for a swing trade, my stop loss would probably be 199 or 199.90, something like that. I need to give it enough room for the time frame of trading so that, hey, if I'm wrong, I need to be clearly wrong. And actually, if you look at the chart, the blue line, it's around 200, So it makes sense that a stop loss around 199.90 would make sense here. I'm not saying that I would take this trade. This is not a trade setup. I'm just hypothetically saying if one were to buy it here, right? Let's also go through an example trade. So let's say $100,000 trading account equity. So especially newer traders, you would rather err on the side of trading smaller. So one shouldn't risk more than 1% of your account equity on a single trade. I know some people are like, 1%. Trust me, you're going to have losing streaks. You're going to have drawdowns. And it's quite possible to go on a 10 trade losing streak. You can do the math on that. If you lost 1% of your account, 10 trades in a row, how much would you be down? Well, you'd be down quite a lot. 10%, 20% drawdowns happen on a regular basis. It's not unheard of to go through, let's say, a 20 unit drawdown. So I'm not saying 20 losing trades in a row, but for whatever reason, market environment might have changed. You're just not seeing things right. Whatever it is, you could have a 20 unit drawdown. And just from an emotional capital and financial capital perspective, we don't want to be having really more than 20% account drawdowns at the at the trough, right, at the valley, at the bottom. So risking 1% of account equity per trade is actually a really good rule of thumb to go by. And I know for some people that may not be enough to get you excited, but you're not trading to be excited. And if you want to be consistently profitable, you have to be disciplined in the risk management and also prove that your strategy, that your process works. So $100,000 trading account equity, let's say, according to your chart analysis, your stop needs to be 10% under where you enter. Okay. So that means that your position size shouldn't be more than $10,000 because your stop loss is going to be 10%. So 10% of $10,000 is $1,000. $1,000 is 1% of 100,000. So this is just basic math, a basic example to use as a rule of thumb for how to manage risk and size your positions. Also, your position size should be based on a combination of your account equity and the percentage stop loss that you're using. So if the stop is tighter, then the position can be larger. If the stop is wider, the position should be smaller. And also the stop loss should be a result of the volatility of the market you're trading. It should be a factor of volatility, not just some random numbers. So that's why I use the average true range to gauge the risk on trades and also to potentially gauge when to take profit. So let's go back to the Netflix chart. So let's actually go through a trade. So let's say I'm waiting for a breakout above the yellow line. So my trigger is 250. If Netflix has an hourly close above 250, I'm getting long and I'm playing the breakout into this open gap, betting on a move back above 300. Okay, and this is a swing trade, so I'm going to give it some days. I might give it a week. I'm going to let it run if it keeps moving into my favor. So let's say hypothetically next week, Netflix comes up, hourly close is 250 exactly. I get long at 250.00. Again, this is made up example. Now, okay, how do I size my trade if I am going to risk one ATR? So my risk is going to be $26.70 per share. So again, we're going back with a $100,000 trading account. So I don't want to risk more than 1,000 because that's 1%. Okay. So 1,000 is the risk divided by 26.70 per share. And there we go, 37.45. So let's round it up. You can round it up to 40 shares. So I'm buying 40 shares of Netflix at 250, and I'm going to put in my stop loss, let's say 222.99. So just give it a little bit extra room there. I'm going to risk basically $27 a share on 40 shares. So let's do $27 per share times 40 shares. And so yeah, it's 1,080. Okay, that's my risk. Now, there's a couple other things that come into play, especially when you're in a swing time frame. What if earnings are coming up? What if the market's suddenly getting much more volatile and this ATR, which is lagging by definition, it's a 14-week rolling average, is not representative of the volatility right now? Well, then a couple things. You can purposely size your position smaller to account for what you're noticing is heightened volatility. Another thing is, if you know there's earnings coming up, then you just don't take the trade, or you get out of the trade the day before earnings, because you don't want to gamble on the earnings. If you're willing to roll the dice on earnings, because the earnings could be good, they might surprise to the upside, and they could be terrible, and you get crushed for $100 per share loss. You don't know. Then just size your position that much smaller. Instead of 40 shares, have it be 20 shares, have it be 15 shares. Maybe use options instead. But that's a whole different strategy. And a lot of traders will just get out, have no position going into earnings and just wait for the reaction to the earnings and see if the setup is still there after the earnings. Let's take an example of a short setup. So that was a long setup, short setup. So let's say you've identified Pfizer is breaking down from a big multi-month topping pattern. You get short on the breakdown. Let's say you're short at $45 a share. This is a weekly chart as well. So you want to risk one weekly ATR 14. So let's round it up to $3 per share. Also, you look at the chart and you notice, well, yeah, if it gets back above 48, then this will look like a failed breakdown and I'll be wrong, right? So you short it at 45 and your risk is going to be $3 per share. So again, let's use our $1,000 risk and divide it by 3. Okay, so Pfizer, you're going to short 330 shares. So 330, $45 a share entry. So your position is about $15,000 short position in Pfizer. Okay, and you have a buy to cover stop at, let's say, 48.10. Just give it a little bit of room above the round number. If it breaks above 48, hits your stop at 48.10. You're forced to cover at market and you're just out. The trade is over. There's no arguing with the market. There's no praying it's going to come back down. That's it. In the meantime, if the trade's working in your favor and Pfizer keeps trending lower, there's a couple of choices. You can just let it ride for a certain amount of time as long as it's moving in your favor, or you can cover in increments as it goes lower. So if you're short 330 shares, maybe you cover 110 at 43, maybe you cover another 100 at 41, and then you keep a trailer for a bigger move, maybe down under 40, right? So there's definitely many different ways to manage a trade, and definitely the devil is in the details. But this video is just focused on risk management, reducing risk and learning how to trade profitably with smaller position sizes that are appropriate for a trader's account equity. Now, junior mining is a whole different beast than Netflix and Pfizer and large cap stocks. So junior mining is a whole different ballgame because, number one, the market caps are much smaller. Usually the trading floats are smaller, and the companies don't have earnings, and they tend to have more random news catalysts. So you don't know when drill results are exactly coming out or what catalyst could come, including financings, right? So there's definitely more volatile sector of the market. So the position size that one might use in Netflix or Pfizer would be completely different for a junior mining stock. Okay, and I just chose Patriot Battery Metals and Snowline as two examples because they're two stocks in the junior mining sector that have done really well in 2022. They have share prices that are relatively high per share They're in the dollars instead of in the pennies, like most junior mining stocks. And they also are pretty volatile stocks. Like look at Patriot Battery Metals. On Friday, it had a low of $5.56 and a high of $6.60. So that was more than $1 per share range for a $6 stock. So we're talking about a more than 15% daily trading range. That's pretty volatile. You can see the daily average true range for Patriot is 51 cents. And it's been trending up as the share price has been trending higher, right? So if you're trading Patriot Battery Metals, I'm not saying investing and holding it for months or years. I'm talking about trading it. Maybe you're buying on a breakout above $5 and then you're selling it, or you're buying it on a pullback. Maybe you bought it at 560 on Friday during this shakeout and you sell it on the way back up, right? So if you're trading Patriot Battery Metals, most likely you need to have a risk range of $1 per share, 2 times the daily average true range, 2 times, because it's such a volatile stock and it's a junior mining stock. I would say the same thing with Snowline Gold. So the average true range, daily average true range is 27 cents. So 2 times, let's round it off, 55 cents. If you're trading Snowline, I would say that your risk range has to be 50 to 55 cents. So you have to be willing to risk a 20% down move. I'm not talking about shorting either of these stocks. I'm only hypothetically talking about trading them from the long side. To realistically give yourself appropriate room to have your trade work, you got to risk like 20% in these stocks, okay? So juniors are much more volatile. And my experience is that during periods of market turmoil, the volatility will usually be well beyond anything I expected it to be. So crazy volatility. And that goes for both the upside and the downside. The pendulum swings both ways. So from a risk management rule of thumb in junior mining stocks, your position size should be significantly smaller than it would be for mid cap or large cap stocks. And I mean like 1/3 the size, maybe 1/4 the size. They should be, your position size in junior mining should be much smaller, and your risk ranges should be much wider, 2 or 3x your risk ranges. So instead of 1 times average true range, you'd be looking at 2 or maybe even 3 times, because the sector is so volatile. I hope this video on risk management helped. And if you found some value in it, please hit the like button and subscribe to my YouTube channel. Thank you.